All right. Well, let's kick this off. We're going to be talking about all-weather strategies. My name's Andrew Stotz, and I'm glad you're here with me today. I'm wearing a necktie because I just got out of a meeting with a client of mine and rushed back home and got to my computer to talk about the all-weather strategies. I hope everybody had a great New Year. I stayed in Bangkok with my mom, and we went out and had dinner and lunches at all kinds of nice places, which was really fun because no traffic and all of that. And I hope that you guys all had a great New Year. We're wrapped up the year of 2023 with pretty good performance, I would say. I'm okay with it. And I'm looking forward to 2024. There's so many things that are going to go on in 2024, in particular, the U.S. election. I'm going to talk at the end of this presentation just a little bit about some of the issues that I see in the U.S. election. And so I'll mention some of that. But I want to welcome everybody and encourage you to say hi and type a hi in the chat. Also, feel free to leave questions in the chat. We're going to go through the strategy as it is right now and also take any questions. And for those of you guys that know me, you know that I wake up very early between, let's say, 3 and 4 a.m. most days. So when I present in the evenings, like at 7 for Phenomena, I'm so sleepy. But I'm not sleepy now. I just had a great cup of coffee and I'm ready to go. And I hope you've had your lunch and you've had your cup of coffee and you're ready to fire away with questions. So welcome, everybody. Let me share my screen and go through the performance a little bit and get started. So I'm going to open up my my computer 1 second, and hopefully I can do this 1 second. Kind of low tech. 1 second. Make sure to share. Hold on. All right. I don't know why my computer's not letting me share. That's a little strange. Sure you could share. Not cancel. Give me a second. I'm just having some technical difficulty, but I'm going to figure it out. 1 second. Let's see. Here we go. I'm opening up my presentation and see if I can share. 1 second. Now it works. Hold on. Okay. So we're going to review the performance for December, and this also obviously looks at the full year. Remember to ask any questions in the chat. I'd love to get questions, and don't hesitate to ask me tough questions too. Remember that our strategies are global. Thailand is just a small part of our strategies. They're also long-term. They're meant for you to be able to gain on long-term equity returns while trying to reduce the damage during the equity market downturns. And also they're diversified globally across asset classes, regions, sectors, and companies. But why are we here? What's the point of what we're doing? The point is to build wealth over the long term. And I see 3 pillars of investing. 1, be broadly diversified. 2, contribute regularly. And number 3 is stay invested. All of those I teach in my book, How to Start Building Your Wealth Investing in the Stock Market. In fact, in a couple of weeks, I'm going to have a course launching at Sasin about how to implement this book. And this book is in English and in Thai, and also I have it as a course. If you're interested, just let me know. So our goal is to deliver steady returns over the long run. And here you can see the 3 strategies we've got. AWS was launched in February of 2019 and targets a 6% average annual return. All Weather Alpha Focus was launched in October of 2021 and targets an 8% average annual return. And Inflation Guard was launched in July of 2022 and targets a 4% return. These are the goals that we've set for these strategies. So from when we started All Weather Inflation Guard in July of 2022, the strategies are all performing almost as expected. If we want to rank the performance right now, what we're going to see is moderate risk. AWS had the highest return, and Inflation Guard had the lowest return, but also had the lowest volatility. And Inflation Guard is meant to have the lowest return. Now here we can see that since July of 2022, all strategies are below world equity, but with lower volatility. So basically, world equity has been on a tear recently, and none of our strategies will massively outperform world equity when it's running up like it has. Let's just look at that for just a second so we understand the situation. Basically, we can see that world equity has shot up quite a bit. Now it's come back down. In fact, I've cut off the top of the world equity there by accident, so don't mind that. But let me just say that when world equity is absolutely racing up, we're never going to beat that because we have commodities and we have bonds and other things in the strategies. But the key thing is that when equity starts crashing, we're not going to crash as much. And that's really the key to the performance. We can see equity crashing here and we didn't crash as much. And that's our objective. It doesn't always work, but that's what we're aiming for. So we create our strategies for decades. Not even a decade, though, is really long term. This is me when I was a little boy, and this is me when I came to Thailand, and this is me when I'm 100. And our aim is to create strategies that perform over many decades. So let's look at what we're going to talk about today. We're going to go through performance review, and we're going to start with all weather strategy, which gained 2.2% in December. Remember that we're 85% equity weighting, but remember also because we've got bonds and we've got commodities and we've got gold, we're never going to match the equity performance when it's really racing up. Here we can see that since inception, the strategy was up 30.6%. This is after fees, an important thing to note. And it's up 10.4%, up 10.4% percentage points above a 60-40 portfolio. Here we can see that the strategy was up 2.2% in December, but it's still 2% below the 60-40. And that's because we can see particularly the US and global bonds and Asia Pacific all have done very, very strongly. And our 25% allocation did well, but remember, we're never going to be like 50 or 100% allocated to, let's say, the US as an example. And our 25% allocation to Japan dragged down performance. If we had more weighting in the US, we wouldn't have had such a lower performance. But again, we're trying to build a balanced exposure. We're not trying to knock it out of the park and be the best performing. We're trying to protect the downside also. Let's look at Alpha Focus, which gained 3.9%. Great to see that in a bull market, Alpha Focus started to perform better than all weather strategy. Remember, we're 95% in stocks and 2% in bonds and 3% in golds. So here we can see the strategy, since its inception, the strategy was down about 7.7%, but about 2.1% above the 60-40 portfolio that we consider to be a reasonable benchmark. And of course, that's after fees for the alpha focus. And about 0.2% above world equity with a lot less volatility. So we're now missed a huge amount of that world equity volatility, and yet we're pretty much at the same place as world equity compared to where it started. That's really a great example of what I'm trying to get to with alpha focus, and that is to have equity exposure but limit the downside. So though the performance isn't above 100 yet, it's behaving the way I'm expecting. Here we can see that the strategy was up 3.9% in December, which was about 0.3% below the 60-40. And basically, out of our 22% tilts, Europe, small caps, and World Infotech did well, and World Energy was a drag on performance, where we had a significant tilt. So now let's look at Inflation Guard, which pretty amazing. Inflation Guard did even better than Alpha Focus in the month of December. Let's recall that with Inflation Guard, we're only 25% equity, 65% bonds, and 10% gold. No commodities right now. Here we can see the strategy was 4.1% up, and that's since inception, and 6.5% above the 40-60 portfolio. Now remember that we changed our index that we're using. And basically for our index, the 40% is K World X, which is equity. And then the 60% is SCB Globe, which is 60% of the index. So it gives you a picture of how we're looking at it. The strategy has also experienced less volatility. Here we can see all-weather Inflation Guard. Actually, even though we did very well, it was up 3% in December. This was still 1.2% below the 60-40. And it mainly because we can see World IT did really well and global bonds did really well. Our 5% target allocation to World IT did great. And the World Equity Fund underperformed the MSCI All-Country World Index. So a little bit of underperformance in the world equity. This is the performance of the mutual fund, but the actual index was a little bit better. And here we can see that gold, money market, and tips was a drag on performance. So I'm going to stop there for just a moment and take any questions that you may have. Let me do that right now. 1 second. And I'm going to stop that sharing. Yeah. Sati, good to see you. And oh my gosh, it's so quiet. You guys aren't saying hi. There's no questions. I haven't presented in the afternoon, but in a long time. So maybe people are a little bit sleepy, but feel free to say hi and also ask any questions. I'm going to take a sip of my drink. It's some passion fruit and some other stuff in it. Let's say, I can't pronounce your name there. I'd say Gon Rudy Noi. I can't pronounce it, but nice to see you. Welcome everybody. We've just reviewed a little bit about our all-weather strategies, which have done pretty well in December. And I think the key message that I take away from that is the idea about keeping in mind that when the equity market flies, my strategies aren't going to fly as much. And that's because we're blending in stock, we're blending in bonds, we're blending in other instruments, a little bit of commodities, a little bit of gold. And so you're never going to get as much return. But hopefully in the downside, we're going to protect that downside. Okay. Bass says, how about clean energy this year to invest? I think I haven't looked at clean energy, and I don't have clean energy as an alternative in my universe for Alpha Focus in particular, where it would potentially be there. But I think that the world loves green energy, right? If anybody can produce green energy, I would say that they're probably already pretty highly rated. So my one thought about green energy is just be careful about the bandwagon effect. The bandwagon effect is when everybody is on a bandwagon playing music, it's very loud, and everybody wants to follow the bandwagon, but it may be too late. So most important thing about green energy is look at the valuation. I haven't looked at valuation of green energy right now, so I can't really answer that. But if the stock valuations are low, it means maybe that the bandwagon effect is gone away, and they could be interesting. So I would say I don't have a strong opinion about green energy, except just to be careful about that bandwagon effect. In general, I'm kind of negative on ESG type of investments in stocks because I think it's overhyped. Oftentimes, it's a way to get higher fees on mutual funds. So I would be very careful if I was investing in any ESG funds. Make sure that you're asking the question, what are the fees related to this fund versus any other? So I'm going to go back into the presentation. Remember, if you have any questions, feel free to ask in the chat, and I'll do my best to answer those questions. So if you can share my screen, let's go back and see if we can look at that. Let's see. All right. So now I'm going to go through and talk about the global outlook right now that I see. First, central banks battling inflation, and they're trying to avoid a crisis. I think the Fed and ECB might be done hiking, which could support equity. And here we can see pretty clearly, I'm going to get my pen here. We can see that interest rates stopped rising in October last year. Now, this is world interest rates, where I've taken all of the bond rates, 3-month government bond yields, and I've taken all of those and I've market cap or GDP weighted them, and we can see that the yield's starting to fall. And basically, the challenge, though, is that the yield curve inversion is still negative. And all recessions in the U.S. since 1968 were preceded by an inverted yield curve. And the average time until that started was about 1 year. So I was expecting fourth quarter, but now I would say, I've said first quarter or into first quarter, I still expect a recession to hit in first quarter. And that's because rising interest rates causes a lot of problems that we're going to be facing. Now, the market is expecting that there's a continued pause in January's Fed meeting. Basically, the market's pricing in an 89% probability for a continued pause at the next FOMC meeting. And that could be positive for equity. Here we can see that the red bars is the next meetings, and the probability of easing seems pretty high. In fact, people are expecting the Fed's going to be easing a lot. Now, what I've said is that we're actually going to go back down to close to zero, because I think that we're going to see a recession come along. And when that happens, the Fed's going to bring its interest rates down to zero. Now, for the past year, we've said, again, that I'm expecting that eventually the course is going to be reversed. And I still expect central banks are going to reverse course and return to accommodative policies as soon as something breaks. And this massive rise in rates will eventually break something. In fact, I was just looking at the data related to consumer debt, and we now have passed more than $1 trillion of credit card or consumer debt. And that is a huge burden, particularly when the average interest rate on that debt is now getting up to about 20%. And when the news turns negative and markets and economies start weakening, I expect the Fed will reverse course and bring rates back down to zero. Plus, you got to remember, this is an election year. So the incumbent party has every will employ every means necessary, the Democrat Party and Biden, to make sure that the economy does well so they get elected in. If you recall, in the last election in the U.S., Biden began selling the oil from the Strategic Petroleum Reserve prior to the November 2000 election. And the result of that was he brought oil prices globally down massively, which brought down inflation, and I would argue really helped him to win the election. And so the reversal could eventually support the U.S. market. It's a mixed bag when you think about interest rates going back down. In theory, that should tell us that the economy is bad and companies are bad, but also it should fuel the stock market. Now, let's look at Japan and EU. They trade way below U.S. equity, and that's part of the reason why I've been looking at them. EU's been getting punished, but still, we have to be careful. I remain overweight EU and Japan because I think that they are cheap. And basically, ECB has continued to pause in December of 2023 and indicated that it would be the peak rate. And EU companies are resilient. They're used to operating in a sluggish growth environment, and investors have lower expectations for developed Europe. Everything I hear about Europe is pretty much negative. So I'm hoping for a surprise. We've got an allocation of 25% in AWS and 22% in European small stocks in Alpha Focus. So Japanese companies have been hoarding cash. They're now sitting on about $2.4 trillion in cash, which is 48% of GDP. And this opens up for share buybacks, investments, acquisitions. In fact, one of the things that we've been seeing is improved corporate governance. And that, in theory, should be causing Japanese companies to re-rate to a higher level. Japanese regulators in the stock exchange are reinforcing its corporate governance policies and for companies to improve. And corporate governance has been a pretty big sticking point for a lot of investors. So they're trying to enhance profitability and bring clarity into cross shareholdings across company groups. And companies could potentially be delisted if it shows that capital isn't used efficiently. And the changes have already started to show in market performance and foreign inflows into Japan. Also, tax incentives for individual investors could lead to more equity investments. In January, Japan improves its tax-free stock investment program for individuals. Like we have our tax-free programs, they have NISA. They're tripling of the annual tax-free quota to about 24,000 US and for an indefinite period instead of the previous 5-year period. Japan's households sit on more than 50% of assets in cash and deposits at banks. So we're likely to see more households investing in stock market with currently low bond yields. So we're targeting right now a 25% allocation to Japan. Now, also oil prices can remain high. What we're seeing is even without significant rises in oil prices, the energy sector can remain profitable at current levels. And we have a 22% allocation to world energy. So it's important to note that we're investing in energy companies, not in this particular case in energy as in the commodity oil. We're investing in the companies that are energy companies. And at least one thing that is different this time compared to the late 90s is that many of the big tech companies are quality companies. These companies have high return on invested capitals and strong balance sheets. And quality stocks should do better in an environment of higher interest rates. Here we can see our weighting is heavier in infotech companies, and we can see that much of the 2023 performance of the US market has been driven by tech. The momentum driven by positive AI sentiment can continue and to have a 22, and we have a 22% weighting to World Infotech in Alpha Focus and 5% in Inflation Guard. Now, what about bonds? They're typically a safe place to be, and global bonds bring diversification benefit to the portfolio. So in recessions, safer assets like government bonds typically have performed well. And though with high inflation, low yields could still lead to negative real returns. And we generally don't allocate the bonds to speculate on the upside, but rather use it to protect capital over time. This is an interesting chart. It's showing the correlation of world equity and that master fund that we're using, SEB Globe. And what we can see is that the correlation is at about 35% roughly. And that basically tells us that this has a positive diversification benefit. Now, of course, I would like to see the correlation be negative, but that won't always be the case. But even at the highest level of correlation, which is, as I say, about 35%, it still provides benefit when the stock market falls. And commodities. Here we can see that oil price has driven commodities in the second half. And the S&P GSCI index, which is the one we're showing here for energy, the blue line, has a 61% weight to energy, while many available commodity funds have less than 40%. So we're heavily weighted in energy in the commodities fund. And food prices have softened. And this is important because there's also soft commodities that we're exposed to. And basically, the main upside in commodities would come from a supply shock or adverse weather or significantly higher demand due to an improved growth outlook. We keep a minimum 5% allocation in AWS and no allocations to commodities in the other two strategies. In other words, if you think that the economy is going to slow, the Fed is going to have to reduce interest rates, then you wouldn't want to be exposed to commodities. And that's why we have a small exposure in AWS of minimum amount that we only have, which is 5%. Now, central banks have been loading up on gold, maybe switching from US dollar. And ultimately, gold protects value in times of uncertainties and market downturns. So central banks have been loading up. We can see as of 9 months how much gold demand from central banks and other institutions. And there's been a lot of different movements in gold, but generally I would say we're at kind of a standstill at this point. There's been a bit of a breakout. But in general, gold is going to protect value in times of uncertainty and market downturns. So what are the risks of our portfolios? Well, one is inflation reaccelerates. Central banks' aggressive rate hikes and QT crashes the markets, or continued rate hikes globally could lower bond yields. And if inflation reaccelerates, we could miss out on rising commodity prices because we're not overweight commodities. I want to stop briefly there and just take any questions that you may have before I highlight one of the key points that I'm looking at related to hold on one second. So let's first talk about commodities. Commodities have generally been a bad investment over the last 3 decades. You generally don't want to have any sizable weight related to in commodities. That's because commodities just doesn't outperform aggressively relative to other asset classes. The other thing is that commodities are highly correlated with equity markets. So when equity markets fall, commodities fall also. So the main time you want to have exposure to commodities is if you're in an inflationary period. We have a shock of inflation, which is what we had a couple of years ago. And we had heavy exposure, 25% exposure to commodities. So the first thing is to understand that we have a very low exposure to commodities, particularly because it's not a great asset class to be overweight in. Now, I want to just mention about China. Touch Chai Wang says, hello. Well, hi there. How do you think about China market in this year? China market hasn't come up in our FEMR methodology yet. When the Chinese market becomes part of our portfolio, you're going to see it, and I'm going to scream from the rooftops that we're moving into China. But I can tell you right now, it's still not attractive to us. There's other markets that provide better opportunity. particularly momentum. China is a market where Chinese people don't really trust their Chinese market. They've been burnt many times with booms and busts in the market. And so what really matters for China, in my perspective, is whether foreign investors are ready to move their assets into China. And I think that the problem that we face there is the political issue is so touchy right now between US and China that there's a lot of US allocators of pension funds and other types of funds that will not allocate to China. And they won't do it because they're afraid that there's going to be a political problem. And the result of that political problem is that they can't get their money out. And so that to me tells me that for a while at least, the Chinese market is not attractive. Now, I will say that if you like China and you want to invest in China, we're definitely down a lot now. And so if you haven't invested in China, I would say maybe now is the time to start to build a small position in China. Nothing wrong with that. But if you're sitting on Chinese losses in your portfolio, I know for many people, they don't want to sell that because they want to wait till it comes back. But I have to say that my experience is that it's not a great idea to wait for a market to come back to sell. It's just not going to come back, and you want to cut your loss and go into an asset allocation space that you believe is popular or has potential. And you've seen me change my strategy very quickly and cut my losses in some strategies in some areas and then get back in. Bass asks, China Tech as well as CQQQ, please analyze. Yeah, I think that China Tech, I haven't looked at that one either. The problem with China Tech for me is that you as an individual investor can bring on as much risk as you want, right? You could put all of your money into one or two things, but me as an asset allocator trying to protect the portfolios of my clients, I have to be very careful. And so China Tech may be a little bit too narrow for me to look at, but I'll mention it to my team about CQQQ and see what they say. And then if I can, I'll look at it. Feel free to ask any questions. I want to thank everybody for joining this live stream. I'm going to take a sip of my delicious drink, and hopefully you have a coffee or you got a drink there and you're relaxing. I'm going to go into the last part of this presentation, which is one of the topics about the U.S. election. We have to try to figure out what's going on in the U.S. election. Bass, before I do that, Bass asked about ETF, Bitcoin. So let's just look at that for a second before I go into the presentation. How about Bitcoin ETF? If it passes, will you invest? No. And if BTF passes, will you have fun for invest for Thai people in the phenomenal report or not? Okay, so first thing is, if we get a Bitcoin ETF, no, I'm not going to invest in it. Part of the reason is because, again, my goal is my strategies are long-term. And my goal is that I'm trying to reduce the risks of the strategy. Now, that's not to say that Bitcoin couldn't be an amazing investment for an individual. And I encourage you, if you like Bitcoin and you see it as a great investment, then maybe the Bitcoin ETF will be a good way for you to manage that with your own money. But I've got to think about our all-weather strategy, our alpha focus, and also our inflation guard. And the volatility of Bitcoin in the beginning is going to be pretty high. So the answer to it is I won't invest in it initially. Now, maybe after a year or so, when things calm down, I'll have a better feeling for it. Now, the second reason why I won't invest in it is because we just don't have that Bitcoin fund in Thailand. And I don't suspect that we'll get that Bitcoin fund that quickly. But Bass, let me look at it when it comes out. One of the lessons I've learned in life is don't get too caught up in hypotheticals. There's still a long way to go before we would have a Bitcoin fund in Thailand. But when we have a Bitcoin fund, I will look at it for sure. But I would say generally, I'm not going to rush into it. Bass has a lot of questions today. Feel free for everybody else, if you have questions, follow what Bass is doing and ask all those questions now. All right. I'm going to go into the last part of this presentation. And this to me is one of the interesting parts. So feel free to ask any questions you may have. Here we can see that there's basically, this is data that I looked at related to the million people that are crossing the border in America. You can see this was the Trump era, and this is the Biden era. 2 million, 3 million, 3.2 million. It's a massive number of people that are crossing into America. In fact, we've had about 8 million encounters in Biden's first 1, 2, 3 years versus 2.5 times 4, 3.5 million for Trump. It's incredible. Estimates are of another 1.7. So we can say 1.7 we can add to this of what's called gotaways, people that have not been encountered. So let's say about 8, and then you got about another 2. So you've got about 10 million people that have crossed the border into America. 10 million people going into America. People from all kinds of countries all around the world. It's incredible. Could you imagine if Thailand opened up the border to Myanmar as an example and said anybody who wants to come across can come across and live in Thailand? What would happen? Now, over the past 2 years, people have been arriving from around the world. You can see El Salvador, Guatemala, Honduras, and Mexico are the big bulk of it, but now more than 1 million people, 1.3 million, are coming from other countries. And in just the month of October, there was more than 50% that have come from other countries. We can see right here, 130 out of 230. And these inadmissibles also, which is a big amount that shouldn't be going into America, what the Republicans are saying is Biden is releasing these people into America. And the Democrats strongly support this, right? Most Republicans, about 70%, but few Democrats say that large numbers of immigrants and refugees coming into the U.S. represent a critical threat to the U.S. Here we can see that it wasn't always this way. The Democrat Party used to say, we cannot tolerate illegal immigration and we must stop it. In 1992, our borders might as well have not existed. The border was under-patrolled, and what patrols there were under-equipped. Drugs flowed freely, illegal immigration was rampant, criminal immigrants deported after committing crimes in America's returned the very next day to commit crimes. Now, Republicans view immigration as a threat, but Democrats do not feel the same. This is a question that's been asked back to 1998. And this is the percent of respondents who see the large number of immigrants and refugees coming to the U.S. as a critical threat. For the Republicans, it's gone up a bit, and it's up now to 68%. But what's critical here is the Democrats have absolutely collapsed. This basically means that 88% don't believe it's a critical threat. In other words, it's their policy. Now, this article outlines some of the reasons for that shift in the Democrat Party. And they said throughout the 80s and 90s, key constituencies in the Democrat Party were worried about growing immigration. And the labor movement was on the more anti-immigrant side of the debate, out of the fear that immigrants were competing with American workers. So, but around 2000, that changed. That NAACP saw immigration as a civil rights issue rather than as a direct threat to Black workers. And For decades, labor organizations had worried that undocumented immigrants willing to work for less pay would push down union wages lower. Now, here's another poll showing that Americans are turning against immigrants. Here we can see the red line says immigration should be increased. Less people are saying that. And immigration should be decreased. More people are saying that that should be. Here we can see another one, which is people who are dissatisfied is rising and people who are satisfied is falling. And that's gotten to a pretty high low point, let's say at 35. That's the gap between these two. So there's something called the replacement theory, and white nationalist far-right conspiracy theory is what they call it. And it was started in France, and they said that Muslim and other non-white people through mass immigration are going to drop in the birth rate of the white Europeans, right? In the US, many Republicans believe that the massive influx of immigrants and refugees is the replacement theory happening in the US. However, low-income inner-city communities could be hardest hit as these immigrants and refugees will take their jobs.
Let me start. NPR reported from August of
Now,
last year.
can you hear that? I'm not sure if you can hear that.
They will spend $252 million on the migrants. $252 million. 17,000 migrants come into this city. And just in Chicago. If we just break that in half and they become families, you got 8,500 families. Hispanics have 3.5 children. I'm submitting to you, in one generation, just one generation, the black vote will be null.
So I want to summarize, and I'll come back to that. Immigration is out of control in the U.S., and it's a hot issue for the election. Democrats approve of it, and Republicans disapprove. And independents side more with Democrats. Uncontrolled immigration could be shifting votes in favor of Republicans and help the Republican candidate. Now, before we get to any Q&A, the Valuation Masterclass Bootcamp number 14 starts on March 4th, and number 13 is starting tonight. And 7 things that our students say about it is that it's a well-designed progression of learning materials, and it's all materials are created by me. It's engaging and fun, and practical assignments is what students work on. And it's a team of professionals supporting continuous guidance and support to accelerate your learning. And it's an intense schedule, and we have a supportive community. So get an extra $100 off if you use the code FINNOMENA. Just go to valuationmasterclass.com/bootcamp or scan the QR code, and hopefully we'll see you in the next bootcamp. Now I'm going to go to any questions, and I want to switch now to my So if you have any questions, feel free to ask. We still got a little bit more time. I'm not sure if you could hear that video or not. Could you hear the video that I put out there? Not sure if you could hear it. Now, Suratas says, will the interest rate not be reduced soon? What are your comments on this? As far as I can see, the 10-year yield stepped up from 3.8 to 4 plus now. It's interesting watching the 10-year rate. It's important to remember that the 10-year rate doesn't move very much. Yeah, it goes up to, let's say, 4.25 and down to 3.75, but it's not a huge amount of movement. And what I would say is that what's happening is that the question really that matters is the short-term rate going to come down? If the short-term rate comes down, the long-term rate may come down to, let's say, 3% or something like that. So I'm expecting the short-term rate to be reduced aggressively in the next couple of months. And that's because I'm expecting the economy to fall and potentially the market to fall. And that's when I would expect that the Fed will reduce interest rates to try to spur the economy. I think we have someone with an announcement coming through my village. Are there any other questions? Chada. In your opinion, what are important events or issues that we should keep an eye on in 2024? Good question. Number one, of course, is the election. And I think that that's really, to me, the thing that I'm watching. If the Republicans win, we're going to see that policies are going to change. And I hope that we're going to be in a situation where there's less threat of war. And less threat of war should reduce risk on the markets and cause the markets to rise. But I don't think that the Democrats, who control all the power in the U.S. through the administrative state and all that, I don't think that the Democrat Party is going to allow Trump to get in. And they have all the power to stop that. My second thing that I'm looking at is recession and trying to prepare for that. I think a third thing for 2024 that's interesting to me is emerging markets, Asia Pacific. You know, when do we see that underperformance start to reverse? And I think that we will see that emerging markets in Asia Pacific will be a good place to invest over the long run. I would say that I hope that we're going to see a resolution to the Russia-Ukraine situation. And I would expect that basically Russia has won. Russia has control of Crimea already and the eastern provinces in the Donbass. And I think that they're going to basically stop at that point and there's going to be a truce. Americans aren't going to like it, but it's going to happen. I think also the other thing that's interesting to me is the swing in politics to the right, in other words, to conservatives. And we're seeing that happening across Europe, which brings me to another thing that I'm watching, which is a backlash against immigration. I think that you're going to see in 2024 more and more politicians being elected that are going to say that they're going to deport the people that have come in to the countries. And I suspect that at some point that the Republicans are going to support the concept of deporting people. As far as sectors are concerned, I would argue that it's hard to see the tech industry being any more attractive than it is. It's highly profitable and the valuations are high. So I expect some underperformance there. And I would argue that value stocks, particularly in America, are going to perform pretty well. That's another one that I'm looking at. In addition, I think you're going to see that interest rates are super high, particularly on credit card companies, you know, and credit card debt and consumer debt. You're going to see that the consumer is going to lose their power. I think that's part of what's happening in Thailand, is that the consumer doesn't have any more borrowing power to drive the performance. Yeah, those are some of the things that I'm looking at right now off the top of my head. Other questions? If you guys could hear that video, I want to play it again because I cut it off short. Let me go back to that video because I think it's a critical thing that this guy is saying. Pay close attention to it, because what I'm trying to say in this, by talking about the immigration issue, is this. Democrats have said that anybody that wants to come into America can come into America, basically. They've opened the borders, they've opened the doors. And that policy, the problem is, and okay, so Democrats, when Republicans say that they don't like this policy, Democrats basically say, you are afraid that you're going to be destroyed. Let's say if you're a white person that's a white person, we're going to have more colored people, people of color in the country than white. And you're just saying that because you're afraid. But what this man is saying in Chicago is the people who are going to suffer are the blacks in the inner cities. Why is this important? Because blacks vote almost 90% in almost every election for Democrats. If the Democrats keep bringing in illegal immigrants into America, at some point, the blacks in the inner cities where all of the illegals are going are losing out, and they're losing their vote, and they're losing the resources that goes to the black community in the inner cities. And then the question is, will the black vote swing to vote Republican? That's why this is such an interesting issue. So let me go back and roll the film. Hold on one second.
Let me start.
All right, let's go.
Let me start. NPR reported from August of last year to December of this year, they will spend $252 million on the migrants. $252 million. 17,000 migrants come into this city. And just in Chicago. If we just break that in half and they become families, you got 8,500 families. Hispanics have 3.5 children. I'm submitting to you, in one generation, just one generation, the black vote will be null. They will have an additional 24,000 people on the voting rolls, along with the Hispanic population already here. They're playing chess, and you all are playing checkers. You are damning our youth, our next generation, to poverty by you all doing these political speeches. One generation, our youth, our vote will be null in all these 6 sanctuary cities. And what are you going to do about that?
Woo! So that is a massive, massive challenge. And the point is, which direction is the black vote going to go? They've been 90% voting for Democrats, but their cities are overwhelmed with immigrants. And if they the Democrats can only lose the black vote, they can't gain anymore. And if the 50% of the black vote swings to Republican, then the Democrats won't be able to win the next election. Now, as of right now, my forecast for the next election is Democrats will win. And that's because they're doing everything they can through social media, through the control of the media companies, and through control of the administrative state to prevent Trump from running. So even if Trump runs, my prediction is the Democrats are going to win by what I would call cheating. And that, I think, is my conclusion as of right now. And my prediction is that Gavin Newsom will be the next president of the United States from the Democrat Party. And that's my prediction as of now. But a lot can change in the next 6 months or so, or 9 months before we get to the election in November. All right, any further questions? We just got a couple minutes left. If you've got any further questions, feel free to ask. Any further questions, feel free to ask. I just want to thank everybody for listening in and, following along with the all-weather strategy and the alpha focus strategy and the inflation guard strategy. And you can count on us trying to stay true to our FVMR methodology and try to provide long-term returns with a minimum amount of risk. So I want to thank everybody for listening and for being involved. And, I appreciate that you guys are, listening and following the strategy. All right. That's it for today's session. It's great seeing you all in the middle of the day when I'm awake with a nice cup of coffee. Chachada, who's on this call, was just recently visiting me with some of her team. And she was saying, yeah, everybody saw that you fell asleep in the last session. And I did, in fact, fall asleep. I was like, whoa, wait a minute. So, but you won't find me falling asleep in the middle of the day. So I appreciate it. And I want to thank you all. I appreciate your time and your effort. Let's have a great Monday, a great week, and a great new year 2024. I hope to see you at more live sessions at Phenomena and otherwise. Have a great session and have a great week and have a great year. Bye.